Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome to the Deep Dive. Today, we are putting on our dealmaker hats. We're diving into one of the most powerful and, let's be honest, often controversial tools in modern finance, the leveraged buyout, or LBO. If you've ever heard about private equity firms making these, enormous fortunes by taking companies private, this is how they do it. It's where big strategy and massive debt collide.
It really is the ultimate exercise in corporate finance discipline. And a successful LBO isn't just about, financial engineering. It demands relentless operational rigor, precise modeling, and, this is the key, rock-solid cash flow management.
Right.
The returns can be, generational, but the downside risks, high-profile bankruptcy, are just as dramatic.
That tension is exactly what we're here to explore. Our mission today is to really give you the shortcut to understanding LBOs. We'll unpack how they work, why they're the preferred tool for private equity, and how sophisticated finance teams figure out if a company can actually handle the immense debt load.
We'll show you exactly where the success stories, diverge from the bankruptcies.
Okay, let's unpack this. Starting at the foundation. What is the fundamental structure of an LBO, and why is that the leverage so important?
Well, at its core, an LBO is an acquisition where the buyer, usually a private equity firm, the sponsor, funds the purchase using two things: a small amount of their own equity and a very, very large amount of borrowed money, the debt.
And that ratio is pretty skewed, right?
Oh, yeah. It often sits around, say, 70% debt to 30% equity, sometimes even higher.
The analogy that always makes this click for me is buying a house with a mortgage. You only put down 20%, the bank funds the rest.
Precisely. It's a great analogy. You put in a small check and you borrow the rest. But here's the crucial difference in the LBO structure.
Okay.
The property you buy, in this case, the acquired company, is the entity that actually takes on the debt used for its own purchase.
Right.
The cash flows and assets of the company being bought are used as collateral for those massive loans.
Wait, let's stop there, because that mechanism is the key flip that I think a lot of people miss. The target company absorbs the debt used to buy it.
Right.
How do you, as the acquiring firm, legally and, ethically justify that? Forcing a company to pay off the debt you took out to acquire it.
It's justified by structure and expectation. So legally, the PE firm merges its acquisition vehicle with the target company, meaning the target assumes the liabilities.
Okay.
But from an operational standpoint, the expectation is that the new, highly disciplined ownership will drastically improve the company's profitability, making it capable of servicing that debt.
So the PE firm uses a small amount of equity to control a huge amount of assets, with the goal of restructuring, optimizing, and then selling for a higher price.
Exactly. And the power of that debt is what really magnifies the returns.
If you invest, say, $10 million in equity, and the company sells for a $50 million profit, your return is 5 times. Simple math. But if you only invested $1 million of your own equity and borrowed the other $9 million, and you still made that $50 million profit, your return on equity is just astronomical.
That's the engine of private equity. That's the whole game. Leverage magnifies the gain. If they can grow the company's value by even a modest amount, say 50% over 5 years, because their equity base was so small, that 50% increase translates into a return on their initial check that can easily top 200%, 300%.
That amplification effect makes LBOs the primary strategic tool. So let's dive deeper into those advantages. Beyond just magnifying profit, what are the, say, 4 key drivers that make PE firms rely so heavily on this model?
Okay, so the first, like we just covered, is enhanced equity returns. It's the sheer math of using OPM other people's money.
Right.
The second, which is strategically so critical, is disciplined cash flow focus.
I find this point fascinating. Debt isn't just capital here, it's a management tool.
It is. It creates this intense, unavoidable external pressure. That debt load is a deadline. The company must generate enough cash-reliable free cash flow to service the quarterly interest payments and pay down the principal.
No excuses.
None. This forces management, the owners, the lenders, everyone to align perfectly around efficiency, ruthlessly cutting waste, optimizing the supply chain, and focusing only on what maximizes immediate profitability. There is zero room for non-essential spending.
And once they're private, they also get this control and strategic flexibility. Being off the public markets must be incredibly freeing.
Total freedom. They don't have to worry about the market reacting poorly to an expensive restructuring or a major layoff or selling off some beloved but non-core business unit.
Mm-hmm.
They can make long-term, sometimes really painful strategic decisions, like
Yeah.
fundamentally shifting the business model, which we'll see with Dell, without that quarterly scrutiny that plagues public CEOs.
And the final piece, the ultimate goal is getting paid on the exit, the multiple expansion potential.
Absolutely. The biggest returns come when the PE firm can sell the company for a higher valuation multiple than they paid for it.
How does that happen?
It happens when they successfully transform the company from, a maybe complex, inefficient entity into a lean, predictable, cash-generating machine. If they buy it at 6 times its operating cash flow, its EBITDA, and sell it at 8 times EBITDA 5 years later, they've already added a huge amount of value. And that's before you even account for the growth they achieved or the debt they paid down.
This is where it gets really interesting. Let's look at how this all plays out in the real world. LBOs are high stakes, and we have spectacular wins and just crushing losses. Let's start with one of the greatest LBO triumphs, Hilton Hotels.
Hilton is a legendary case, largely because of the timing. Blackstone acquired the hotel chain in 2007 for $26 billion.
$26 billion, wow.
And they literally closed the deal just months before the global financial crisis hit. Just decimated the travel industry worldwide.
That sounds less like financial engineering and more like financial suicide. They must have thought their entire investment was just gone, wiped out.
For sure.
What saved them? Did they have to immediately restructure the senior debt, or did some specific covenant buy them time?
Well, they definitely felt the pain, but Blackstone's ability to survive really came down to two things. First, the resilience of Hilton's core business model. It's a strong global brand with a loyal customer base.
Okay.
And second, a deep, deep operational focus. Instead of defaulting, Blackstone doubled down on improvements. They invested heavily in digital transformation, modernized their reservation system, and focused ruthlessly on streamlining costs at every single property.
So the discipline forced by the debt meant they couldn't waste money, but they had to find profitable areas to invest in to survive.
Exactly. When the market eventually rebounded, Hilton was leaner, more technologically advanced, and better positioned than its competitors.
And the exit.
When they took Hilton public again in 2013, it was a massive success. It delivered one of the most profitable LBO returns in history. It proved that real operational improvement, not just financial sleight of hand, dictates success.
Another often cited success, but for different strategic reasons, is Dell Technologies.
Dell's LBO in 2013, led by Michael Dell and Silver Lake, was a textbook example of needing private capital to execute a painful strategic pivot.
Right. They're trying to get out of the PC business, basically.
They were trying to transition from being a low-margin consumer PC manufacturer, a business facing just relentless competition, into a high-margin enterprise solutions company focused on software, storage, networking.
That's a fundamental shift. The public markets would have never tolerated the years of cost-cutting and massive spending that requires.
Never. They would have slaughtered the stock price every single quarter. Being private provided the essential operating room. They could make deep cost cuts, acquire strategic firms, reprioritize everything without analysts screaming about quarterly earnings.
And the debt discipline helped them make those painful choices.
It did. The result was significant value creation before they returned to the public markets in 2018, having successfully transformed the company.
Now we have to turn to the cautionary tale, the failure that highlights the lethal combination of high debt and a disrupted market. Toys R Us.
This is the poster child for what happens when the math goes wrong. Toys R Us was taken private in 2005 with over $5 billion in debt.
Wow.
At the time, they were a strong brand, but the retail environment was changing at, breakneck speed.
E-commerce was growing. Big box stores were undercutting them on price.
And the problem was that retail is a low-margin, cyclical business. They simply could not generate enough consistent, reliable cash flow to both service that massive debt load and invest in desperately needed store modernization and a competitive digital platform.
So the debt service was this fixed, immovable expense while their revenues were shrinking.
Precisely. The debt didn't amplify success. It strangled the company's ability to adapt. Without cash flow, there was no money to reinvest. The stores looked old, the prices weren't competitive, and ultimately, the weight of the interest payments just became overwhelming.
And they filed for bankruptcy in 2017.
They did.
That story really shows us what happens when cash flow fails the stress test. So how exactly do finance teams stress test that cash flow before a deal even closes? Let's get into the analytical backbone of this, the LBO model itself. What are the technical mechanics that dominate that analysis?
Okay, so the LBO model is a deep financial projection, and it's built around four core mechanics. The first is detailing the capital structure, how every single dollar of the purchase price is funded. And this structure is layered, reflecting different levels of risk and cost.
Tell us about those layers. What does a PE firm need to know about, say, senior versus subordinated debt?
You start with senior debt. This usually comes from major banks. It's the lowest cost and lowest risk because it's secured by the company's assets. These lenders get paid back first if things go south.
Okay, the safest position.
Then you move into higher risk, more expensive debt, things like subordinated debt and often mezzanine financing, which sort of sits between equity and senior debt. These lenders demand higher interest rates because they're unsecured and paid back later.
And at the very bottom,
You have the sponsor equity, the riskiest capital provided by the PE firm itself, last to get paid, but with the highest potential return.
and the second mechanic must be the key focus for every lender and every analyst, cash flow coverage. This is where the deal lives or dies, right?
It absolutely is. Lenders focus on a few key metrics. The first is the debt to EBITDA ratio.
Okay, let's define that clearly for everyone. What is EBITDA, and why is that ratio so important?
So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's widely considered the best proxy for a company's operational cash flow before you factor in capital structure or accounting quirks.
Okay.
The debt to EBITDA ratio tells the lender how quickly, in years, the company could theoretically pay off its entire debt load using its current cash flow. If that number is too high, say 7 or 8 times, EBITDA lenders start to panic.
Because that's 7 or 8 years to pay off the debt, assuming perfect performance.
Exactly. They also obsess over the interest coverage ratio, which tells them how many times the company's operating cash flow covers its annual interest payments. And finally, they look at the actual free cash flow remaining after all debt service. If these ratios fail the stress test if the company can't cover its interest in a simulated recession, the deal won't get funded, period.
The third mechanic addresses the future, the operational improvements or the value creation plan. The PE firm has to actually model every efficiency they plan to achieve.
This is their operational thesis. Analysts meticulously project cost reductions through supply chain optimization, maybe planned revenue growth, margin expansion, asset sales. They have to prove that the company's future value, under their ownership, will be significantly higher than its current value plus the cost of all that debt.
And finally, the whole thing hinges on the exit strategy. How is that massive return actually realized?
The final value, and thus the ultimate return on equity, your IRR, is determined by 3 variables working together. First, how much EBITDA growth they achieved. Second, the total amount of debt paid down.
Right.
And third, the final exit multiple, the valuation the market assigns to the company when it's sold, which they hope is higher than what they paid.
That brings us to the crucial counterpoint.
Yeah.
We see the successes, but what are the predictable failure points? When you look at deals that collapse, what are the biggest red flags?
The immediate non-negotiable red flag is insufficient cash flow. If the company is in a cyclical industry or one with margins that are just too thin and they can't reliably generate the funds to meet those mandatory interest payments, the clock is ticking toward default.
And that often ties into taking on aggressive leverage levels right at the start, doesn't it?
They are deeply connected. An LBO with 6 or 7 times debt to EBITDA might seem manageable in a booming economy, but a minor downturn, a pandemic, a sudden rise in interest rates, instantly makes that entire capital structure unserviceable. Aggressive leverage removes all margin for error.
We also see the failure of the human element. Deals based on overly optimistic assumptions.
Absolutely. The models are only as good as the inputs. If the projections rely on unrealistic cost cuts that end up crippling the business, or if growth expectations are based on fantasy, the foundation of the deal is just flawed from the start. A real stress test should break the model, not just confirm it.
And the final failure point often involves the surrounding environment, competitive or disrupted industries.
This is the lesson of Toys R Us writ large. High leverage is toxic in sectors with intense competition, low margins, or high technological disruption. LBOs thrive in industries with stable, predictable, almost subscription-like cash flow, think software, healthcare services, certain infrastructure, not volatile retail. The ultimate due diligence question for any finance professional looking at an LBO candidate just boils down to this. Is the company's cash flow stream durable, predictable, and defensible? If there's any hesitation in that answer, the debt load is probably too risky.
So to summarize this fascinating dynamic, let's quickly review the 6 strategic elements that truly define an attractive LBO target.
We've established that success requires: first, strong, stable cash flow. No surprise there. Second, durable competitive advantages that protect your margins. Third, clear opportunities for operational improvement, the actual plan to make the company better.
Right.
Fourth, a commitment to reasonable leverage levels. Fifth, a clear exit strategy defined from day one. And sixth, all financial assumptions must be realistic and rigorously stress tested.
So LBOs, at their heart, are far more than just financial engineering. They are a demanding exercise in operational rigor, disciplined planning, and a clear path to creating real value.
And since that immense debt in an LBO forces such relentless efficiency and cash flow discipline on management, it raises an important question for you, the listener. If LBOs fundamentally transform companies through the pressure of leverage, what does the absence of that severe debt pressure imply for the long-term strategic flexibility and operational focus of companies that choose to remain in the often comfortable public markets?
A compelling thought to chew on as you review the priorities of the public firms in your own portfolio. Thank you for joining us for this deep dive into capital structure and risk. We'll catch you on the next one.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.